Abby, just simply now, can you at the margin acquire equities this morning?
That's a terrific question, Tom, for traders. And the answer is, of course, it depends upon your time horizon. The Goldman Sachs house view is that S&P 500 is currently modestly undervalued. And of course, that's based upon the straight arithmetic, what we expect for corporate profits, but also very importantly, what we expect from the Fed. And if you think the Fed is going to stay friendly, then there could be some room to grow in the equity market. By the way, not just in the United States, but in the other major markets as well. However, what we've discovered is that there is intense volatility, and it has been rising. That is not unusual as we approach a major election in the United States. And also as we see that there has been some erratic movement with regard to fiscal policy. It's not just the Fed. We're also now looking at what happens to the stimulus bill. I think it was very clear over the last few days, FOMC and other statements from the Fed, that they believe we need another stimulus package.
Speaker Pelosi with David Weston here in the 12 noon hour. Abby, I want to go back to 1987 when it was just so darn simple. John Templeton was there, Schreier was there of Merrill Lynch, Robert Kirby, and they talked to Lou Rukeyser about the simplicity of a stock market major crash, et cetera, et cetera. Now, there is so much complexity. There is so much information flow. How do you stay with a conviction call on equities given the complete cacophony of information that we have?
You know, 1987 was a market event. Basically, the economy had not been afflicted by whatever was going on. So it was okay to go back to those models, do a calculation about valuation. That is not the situation right now. And I have to tell you that I am quite concerned that there could be considerable downside as well, depending on any number of factors that we can't fit easily into our models. This includes what will the Congress do? What will the president say? And of course, the election outcome. And so those of us who have lived our professional lives really focusing in on the math, I think should feel very humble right now, because what we recognize is that the models may not be able to properly reflect all of the volatility, not just in the markets, but in the economy, in policy, and also, of course, in investor sentiment. One other thing, within the equity market itself, there are wide gaps in relative valuation. And that tells us something too. When markets rising, what we see is that there are just a handful of stocks that tend to drive that performance. And that, of course, could make the market more suspect as well and more volatile and vulnerable should there be some disappointments with regard to just a small handful of those particular issues.
Abby, well, good morning from London. What exactly is the market you think pricing in at the moment? And when you say, you know, it is very difficult to read what the U.S. election will bring in terms of composition of the House or even, you know, giving of power if Joe Biden were to win. So how does the market react in that case?
When we take a look at a lot of the surveys that are done of investors, what we're seeing is I don't want to say presumption, but the increasing probability of, let's call it, the blue wave. There seems to be a probability that Mr. Biden will be elected based upon polling. There is the possibility that the Senate could switch over to the Democratic column. And of course, there is the presumption, this is a presumption, that the House will stay blue. And what we're seeing from investors over the last several days is that a blue wave might not be such a bad thing, because it would give us more certainty with regard to policy, particularly with regard to the use of fiscal policy to help our economy at this point. The general sense is that while the economy is recovering, it is recovering slowly, number one. Number two, there are structural problems that need to be addressed in terms of long-term unemployment, some of the industries that have been very hard hit. And these are things that interest rate policy writ large doesn't really help. It has to be done through fiscal policy. And so what we basically see is that investors are now looking at the possibility of movement toward the Democrats that may in fact be viewed in a positive way. And here I'm talking about not the short-term modeling based upon what's happening in this year's corporate profits and so on, but rather the longer-term outlook for 21 and beyond.
But what does it mean for how? So let's say we do have a Biden administration with actually, also Democrats in the House. What does it mean for how the economy will change in the U.S.?
Yeah, one of the things I believe that I've picked up anecdotally, and I stress this as anecdotally, is that when I speak to investors, there is some uncertainty as to what the president plans would be in a second term. So there's not really an understanding beyond tax policy in terms of what would happen. There's been disappointment, for example, in terms of no follow-up on infrastructure policy. There are concerns in terms of what would happen with regard to regulatory policy, particularly as it relates to some environmental issues. And there are also some concerns as it relates to healthcare. One of the things that many investors are now concerned about, as are many voters, is that we have a rise in unemployment. Fortunately, it has been moving lower. One of the reasons it's moving lower is not just because jobs are being restored. We've now restored about half of the 22 million jobs that were lost. But we also see that people are stepping out of the labor force. And just the arithmetic of what is an unemployment rate, the denominator is the number of people in the labor force looking for jobs, and we see that that number has been getting smaller, and that is of concern to many people. And so when we take a look at what investors are concerned about now, not much concern about what this quarter's earnings will be or next quarter. And even for 2021, even though the Goldman Sachs view is a little bit stronger than the consensus, the general view is that world economic growth will be jumping up 6 to 8% next year, in part because of a low base. But what happens after that, and what happens to some of the structural problems that have been unveiled by, in fact, this very difficult pandemic?